Nvidia reported $215.9 billion in revenue last year, but an estimated $58 billion of that may be synthetic demand the company effectively financed itself. Welcome back. Today we're looking at the bull case for Nvidia, and then working through why it may be more fragile than the headlines suggest. Circular financing, collateral collapse, margin risk, and a valuation that prices imperfection. As always, this is not financial advice. Be sure to do your own research. Now let's get into the data. Start with what the bulls have right. Q4 fiscal year 2026 revenue came in at $68.1 billion, up 73% year over year, beating Wall Street by over $1.5 billion. Guidance for the next quarter landed at $78 billion. Those are exceptional numbers by any standard. Behind that demand sits a structural commitment. The 5 largest hyperscalers, Amazon, Alphabet, Meta, Microsoft, and Oracle, collectively disclosed over $710 billion in 2026 capital expenditure plans, with roughly three-quarters of that directed at AI infrastructure. That is the demand floor the bull case rests on. One more number worth anchoring for the counterargument. $62.3 billion of that Q4 revenue came from a single segment. Data center now accounts for 91% of everything Nvidia earns. That concentration is both the strength and the vulnerability. So the growth trajectory is undeniable, the CapEx commitments are on record, and the segment dominance is documented. The bear case does not dispute any of that. What it disputes is how much of that demand is organic and how much was effectively engineered. That disputed portion of demand traces back to roughly $110 billion in what can only be described as circular financing. Nvidia committed $100 billion to an OpenAI infrastructure partnership, took a $3 billion equity stake in CoreWeave, and injected $2 billion into Nebius. Those entities then used that capital to buy Nvidia hardware. This structure has a historical precedent worth taking seriously. Lucent Technologies financed cash-strapped telecom startups to buy its own fiber equipment. When those startups defaulted, Lucent's revenue evaporated, and its stock fell from $80 to $2. Nvidia's circular financing ratio, roughly 51% of annual revenue, is nearly 3 times Lucent's at the bubble's peak. OpenAI's own CFO removed any ambiguity here. Asked about the $100 billion partnership, the CFO acknowledged that most of that capital would go back to Nvidia in hardware purchases. That statement alone raises direct questions under ASC 606 about when and how that revenue should be recognized, and whether the SEC will eventually require different disclosure treatment. CoreWeave is the clearest window into why this matters. The company carries $21 billion in debt at roughly an 11% average interest rate. That interest burden alone consumes about 25 cents of every revenue dollar. Fiscal year 2025 net loss came in at $863 million. At what point does a customer become a liability Nvidia is carrying? That CoreWeave debt we just covered is secured against hardware that has lost more than half its value. H100 secondary market prices have fallen from the $30,000 to $40,000 retail range down to $12,000 to $16,000. Cloud rental rates dropped from an $8 per hour peak to roughly $285 to $350 today. When collateral depreciates that fast, debt covenants become fragile. If a neocloud breaches its covenants, lenders force GPU liquidations, flooding secondary markets with cheap silicon that directly undercuts Nvidia's new hardware orders. One default can trigger the whole chain. Now add a contractual layer on top of that. Nvidia carries $29.8 billion in non-cancelable take-or-pay manufacturing obligations with TSMC. If organic demand stalls for any reason, Nvidia is legally required to purchase that silicon regardless. Relative to recent annual free cash flow and net income, that obligation is substantial. Those obligations matter more when you see how fast margins can actually move. Nvidia's $4.5 billion H20 write-down compressed GAAP gross margin to 60.5% in a single quarter, down from the 75% baseline we noted earlier. China was only about 5% of revenue at the time. The small demand pocket produced a 15-point margin swing. Beyond those margin risks, there is a quieter signal in the inventory data. Days sales of inventory expanded from 73 days in late 2024 to roughly 103 to 105 days by early 2026. Quarterly inventory turnover dropped to 0.87x. Chips are accumulating faster than they are being deployed. That inventory buildup has a physical explanation. Nvidia can ship chips in weeks, but connecting a gigawatt-class data center to the power grid takes utilities 3 to 5 years. Hardware is arriving well ahead of the infrastructure needed to actually run it. While chips sit idle waiting on power permits, the debt clock keeps running. CoreWeave services 11% interest on that $21 billion stack, whether hardware is deployed or not. Idle hardware earns nothing. The physical bottleneck is directly fattening neocloud losses. The inventory and power problems compound a structural competitive shift. Custom ASIC share of data center inference has already reached 37% and is projected to climb to 45% by 2028. Broadcom controls an estimated 60 to 70% of that XPU market, with design partnerships locked through 2031. That ASIC share gain we just covered has a named face. Anthropic, at $30 billion in ARR growing 30 times over 15 months, explicitly bypassed Nvidia and committed 3.5 gigawatts of Google TPU capacity through Broadcom starting 2027. The fastest-growing frontier lab chose non-Nvidia infrastructure for scaled inference. Anthropic's decision didn't happen in a software vacuum. OpenAI's Triton compiler now matches and sometimes exceeds hand-tuned CUDA performance, with backends covering TPUs, AWS Trainium, and AMD hardware. PyTorch 2x adopted Triton as its primary fusion engine. The software layer is decoupling from the silicon. Hyperscalers aren't just switching compilers, they're financing the competition. Meta announced a $100 billion AMD chip deal with an option for a 10% equity stake. AMD's MI300X and MI350 series offers roughly a 39% cost reduction versus comparable Nvidia hardware. When customers start buying equity in your rivals, pricing leverage shifts. All of that competitive pressure lands on a customer base that is already dangerously concentrated. 2 unnamed customers represent 36% of Nvidia's total revenue, one at 22%, one at 14%. Meanwhile, CSP receivables jumped from a historical average of around 24% to 65% by Q3 fiscal year 2026. That shift hands hyperscalers real negotiating leverage. On top of every competitive pressure we've covered, China data center revenue is effectively zero in current guidance. And if Nvidia resumed H200 exports, a mandatory 25% revenue sharing agreement stacked on top of 25% tariffs would mechanically gut margins on every unit shipped. Pull those threads together, and reported revenue looks different. Forensic estimates suggest somewhere between 25 and 35% of data center revenue, roughly $58 billion, reflects neocloud or vendor-financed orders. Strip that out, and organic revenue lands closer to $158 billion, which changes the multiple considerably. Rather than predicting when this resolves, 3 specific triggers define when the bear case activates. H100 spot pricing below $1.65 per hour. Inventory turnover below 3.0 with days sales of inventory above 105 days for 2 straight quarters. And gross margin guidance under 72% for 2 consecutive quarters. Sell-side base targets of $240 to $285 imply a path toward a $12 trillion market cap on the bull end. No semiconductor company has sustained 75% gross margins across a full hardware cycle. The multiple requires a monopoly that the last several sections have shown is already fragmenting. 3 structural risks are converging at once: custom ASICs, eroding inference pricing, circular financing that depends on neocloud solvency, and nearly $30 billion in locked supply obligations. Each risk is significant alone. Together, they compound. Bull or bear? Drop your take in the comments. I looked at this data and couldn't set it aside. So there it is. Nvidia has built one of the most remarkable technology franchises in history. The engineering is undeniable, the ecosystem is deep, and the revenue is extraordinary. But when you follow the debt chains, trace the collateral, and map out who is actually paying for what, a different picture starts to form. A $110 billion financing exposure, a $29.8 billion supplier obligation, neoclouds burning 25 cents of every revenue dollar on interest, H100s liquidating at 70% below retail, and the best frontier labs quietly routing around CUDA entirely. I'm not here to tell you the stock goes to zero, but I do think the risk is being priced as though none of this exists. So tell me where you land. Are you buying this dip, or do you think the air pocket is still ahead? Drop your take in the comments. And if this kind of breakdown is useful, subscribe. There's more coming. I won't pretend I'm always out here hunting for the contrarian angle, but this particular stack of data stood out as something I couldn't look past.